I learned one key important lesson from an institutional trader that is counterintuitive, but has actually helped me become a profitable trader. And I want to share with you exactly what it is. It might even be the reason you're not seeing consistent results. But before we get into that, who is this institutional trader I'm talking about? Well, this is Robert Carver, and we're going to go over something that challenges most traders and is actually a key mistake many traders are doing. Now, Robert actually worked at AHL. If you know sort of the hedge fund space, you'll kind of recognize that name. And he developed a global macro strategy and managed a multi-billion-dollar fixed income portfolio. He also served as a research manager at CEPR and traded exotic derivatives for Barclays. So as you can see, he has a lot of institutional experience, and the man I'm talking about here is right in this photo. He also has written 3 amazing books, Systematic Trading, Leverage Trading, and a book around future strategies. I haven't been sponsored by him or anything like that. Personally, I've paid my hard-earned money for each one of his books, and they're really, really solid books, especially if you're trying to get into systematic or algorithmic trading. But what is this key mistake that I'm talking about? Well, it's that the best systematic traders almost never modify their strategies. Now, you might be thinking, that sounds very unrealistic. Why would you never modify it? Maybe you want to optimize it, or maybe some recent events happened and you should change your parameter values, right? Well, this isn't really the case, and this is a really important lesson to go over. Most traders consistently tinker with their systems, trying to optimize and improve them based on last week's result. Keyword here, last week. Now, you might find it a bit shocking, but on one of the podcasts Robert Carver was on, he hasn't changed his system's basic parameters in 8 years. Now, I've only been trading for 5 years, maybe about 5 years and a half, so I can't really quote on if I'm going to change mine over the next 8 years or so, but to be able to stick to the same parameter values or basic parameters that you're using is incredibly impressive, and it means he's built obviously a very robust portfolio, and at least from podcasts, he's mainly mentioned that he's around risk premiums. If you're not too sure what those are, I actually have a video around like alpha in trading, the most important thing in trading. You can watch that after this video. Now, the key quote actually from that podcast was, he mainly mentioned here, let me just zoom out a quick second, here we go. What extra information have I got in the last year, the last month, that would allow me to say that the system should be fundamentally very different? The answer is almost none. Now, I'm going to break down kind of 3 key things he said here. First is the time horizon, right? So he's saying last year, last month. Now, for most systems, I would say probably in a year, you probably would have enough data if you do need to make a change. Just because most, at least strategies I've seen personally, you're going to have enough data, meaning that you'll have like at least 200 plus signals in a year. If you don't, if you're trading something like swing trading, then yeah, definitely a year's worth of data is not enough to get statistical significance. Now, if you're not too sure what that word is, don't worry, I'm going to explain it in just a moment. And then also, like he says, last month. Last month is a very clear case for most trading strategies, unless you're trading something very high frequency, you won't have enough data to make solid decisions on how you should change your strategy. And then this goes into the kind of last point here is what is fundamentally very different. A clear example of this, right, is if you're running a trend following strategy. So this is just where you're kind of going along with the trend. Those are going to have a natural con, which is they're not going to work very good in choppy markets. That doesn't necessarily mean your strategy is broken now if it's a choppy market regime, because it's still a sound strategy type. Trend followings do work and have consistently worked over many, many years. So just because it isn't working because of this choppy market regime at the moment doesn't mean it's fundamentally very different, or you should completely remove that approach, add 5 new parameters, etc. And then, if nothing's fundamentally very different, you shouldn't change your strategy. So that's kind of how he's been able to get to around 8 years of running his portfolio, and he's always kept to the basic parameters. Now, here are 2 simple reasons you should avoid constant tweaking. This goes into the word that I just mentioned, which is statistical significance. Short-term performance isn't statistically meaningful really in any way. To give you a really cookie cutter example of this, it's not perfect, but this should explain the concept, is let's say we have a coin toss, right? We have heads and we have tails. Let's say we flip the coin 3 times and we get heads each time. Does that mean that because I've got heads 3 times, I should bet on heads next time? If you take a moment to think about it, anyone that has some knowledge of statistics, it's a very basic concept, will know that that doesn't determine anything on the next particular event. And also, it doesn't mean that there's necessarily an edge here for heads because it's only 3 coin flips. If you look at a statistical significant chart, or like the law of large numbers charts, you'll see it go wide at the beginning, meaning that the odds of any one event could be very high, and then it will go to the expected value after enough events have happened or enough samples. It kind of looks like this. So it's like, and then it gets smaller and smaller and smaller as the axis with samples here kind of adds to it. So let's say we then flip this coin 1,000 times. Now we're going to get to around the percentage, which is about 50-50, right? So that kind of shows us the expected value of this coin toss. And that's statistically significant because there's enough samples there and evidence to back up that particular observation. So if we bring it back to what we were talking about, let's say you had a trading strategy and it stopped working, or you had a couple losing trades, let's say it was maybe 10 of them. 10 trades is not enough data for you to get anything that is statistically significant, meaning that short-term performance isn't statistically meaningful. So you shouldn't be changing anything based on those particular events. Also, recent market behavior rarely justifies system changes. Markets obviously change and adapt, right? And you could have a week, especially if it's something that's quite cyclical. So let's talk about, for example, small caps. Small caps is really anything under 500 million market cap on equities. And if you're shorting them, because there's a natural edge there, they can be very cyclical, meaning that you can have weeks where they perform amazingly well, and you can have 1 or 2 weeks where everything is going against you. And those are the times where you have to really protect your risk capital. But that doesn't mean small caps is fundamentally broken. It doesn't mean that there's no edge there. Because if you had just looked at that very small sample of that week where it didn't work, you would say, hey, well, it lost all its trades this week. That doesn't take away from the actual evidence of, 5-year backtest or whatever, that particular strategy works. And then a real life example that Carver actually mentions on a podcast is during COVID-19, fast trend systems outperformed slow ones dramatically. And many traders switched to a faster system, but this was just one episode in 50 years of market history. And that kind of just sums up what I was talking about before. Now, the next point is psychological pressure. When systems lose money, there's immense pressure to do something. He talks about this more on the institutional side, but I think as a retail trader, you can also kind of see where he's coming from, especially of how it feels for yourself when you're running your own strategy. And the correct response is often to do absolutely nothing. Now, to actually give you the quote, it was when systems is losing money, you're getting calls from clients complaining and saying, what are you going to do about this? The correct answer is often nothing. And I think this sums it up perfectly. It's a very uncomfortable thing to do nothing when you're trading, especially because most of the time, if you're retail trading, you're controlling all the inputs. So it feels like you need to do something because you are losing money this week. You need to change your parameter value. You need to change your strategy. You need to turn off a strategy, whatever. It will always feel like that. It's a very uncomfortable feeling. But as I kind of like to say, and it's not something I made up, but no pain, no gain, obviously. And that really does apply to trading as well. You have to be able to hold through painful things to be able to get the reward, which is often the edge or alpha that you're extracting. If it was completely, you had no pain, you would be holding a bond, or you would be holding something like a high interest savings account that is just going to be going up like that. But it's only 2.5% or 5%, I guess, depending on where you're going. And that's something where you don't have to hold any pain, but you're getting paid way less for that because there is no pain involved. If you have pain added to it and you actually have something that's obviously profitable over the long haul, that is why you're getting an edge as well to that factor. Now, the better approach to kind of leave you with a solution for this video is you want to build simple and robust systems. Let me just move my camera real quick. There we go. You want to build simple and robust systems. So that is core system types. So like this is like trend following, mean reversion, arbitrage, etc. And they want to be overall quite simple. That some people will debate if you want to go more complex, but most of the things that actually work on live markets are going to be ultimately more simple, meaning that they are lower parameter count, they haven't been overly optimized, etc. You also want to test thoroughly before going live. If it's a very short-term edge, so let's say it is an arbitrage, if you're not too sure what that is, it primarily is where you're getting 2 different pricings from 2 different exchanges, let's just say, and one of them is more favorable than the other, and you can arbitrage between those, or something like that, or if you have like a funding rate arbitrage. Those sort of things are normally more short term, so you may not need to test these as thoroughly because you need to take advantage of them as quickly as possible. Maybe you want to do some sort of test, but it doesn't have to be as extreme. Whereas something like a trend following approach, a mean reversion strategy, core strategy types, you want to test them very thoroughly because it's a very important thing to do still. Then you want to let them run for extended periods of times without changes. This is the part no one likes to do, and I'd also say this is probably the most consistent thing I see people kind of make a mistake on. A lot of people will get into maybe systematic trading, or even just trading in general. They'll have a strategy, it's sort of working, and they change it after a week because they had 2 losing trades, and they think they need to change the whole parameter value, the parameter counts, and that's just not how trading works. You need more data to actually get solid data behind if you should make a change. And then the last one is you only modify for fundamental changes in market structure or trading costs. So if you find something, for example, like you take a strategy live, and for every trade you're taking, let's just say this is a dollar. If every trade you're taking, your slippage and your costs were way more than you anticipated, then yeah, you're gonna need to make an immediate change, because that's just not gonna work. You modeled something, or you backtested something that was fundamentally incorrect, and it wasn't a realistic environment. The second one is market structure. So an easy example here would be probably 2020. Or I guess this would be like 2020 to 2021, give or take. If you were doing a long only breakout strategy during then, you had incredible profits and you had incredible win rates because the overall market was getting hugely stimulus, meaning that, you know, we were getting the stimulus checks, etc. The market was running because of that. It was also printing us on money. That is a fundamental market structure that has changed after that. So if you were running, you know, something specific around that, let's even give a better example. If you're doing like an OTC strategy during then, market structure has fundamentally changed, meaning that strategy probably is no longer working as for OTCs, meaning that those are going down. So something like that, then you can make a fundamental change, or if you have enough data for it. If you've let it run for an extended period of time, let's say a year, let's say a couple of quarters, and you find fundamental data that, hey, this needs to be changed, then solid. Then you can make that particular change. But this was a quick video from me. If you enjoyed the content, feel free to subscribe, and I normally do at least 1 or 2 videos every single week.